Hi, my name is Jay and I make finance videos. And the purpose of today's video is going to be talking about that age-old question on how much mortgage can I afford? Sort of the what is my number? And let's just dive right in. So really the starting point for figuring out how much mortgage you can afford or what kind of mortgage you can afford is using something called a mortgage calculator. And there's a lot of these out there, but you can find one that works on financesdoneright.com. You can go into the tools section in the real estate area and you'll find one that works right there. It provides you with graphs and easy to use information that will also show you how much interest you'll pay over the lifetime of your mortgage. Now, you're going to need a little bit of information to put into that mortgage calculator before you can actually get the amount of mortgage that you can afford. And so let's break down those things right now. The first thing you're going to need is your interest rate. Now, the easiest way to get a very accurate interest rate is to actually go to the lending institution or organization that you're going to go to get your mortgage and provide them with your credit history, the amount of debt that you have, and the sort of income or stable income that you have as well. And they'll be able to give you a fairly accurate estimation of what kind of interest rate you'll see. But realistically, that's a lot of work, and you really are probably only going to do that if you actually plan on getting a mortgage in the near future or in the very near future. For the rest of you, an easier way to do it is actually just go to a financial institution's website and they will have sort of average interest rates on there, and they'll be sort of different based on fixed, variable, open, and closed. And basically you can choose whichever one you prefer based on your preferences for how you plan to structure your mortgage. If you have no idea what those terms are, I've made a video previously about fixed, open, variable, and closed. Very important to understand what those are if you're planning on buying a home, so I'd highly recommend you go check that out. So sort of choose whichever interest rate based on your preferences. It's really important to note though that these interest rates are often going to be for the ideal mortgage candidate. So it's the person who does have good credit, who has very little debt, who has steady, stable income. So if any of those sort of variables don't apply to you, you can likely expect that interest rate to be higher for you when you do actually go to get your mortgage. But it's a good starting off point if you're just hypothetically looking at what kind of houses you might be able to afford. So you have your interest rate. The second thing you're going to need to know is how long you plan to actually have the mortgage for. And typically it's going to be, you're going to want to go between 15 to 25 years. Now, if you live in the United States, actually the most common sort of mortgage length is 30 years. Now, I would highly recommend you never go more than 25. And the reason being is the longer you take to pay off your mortgage, the more interest you're going to pay to the banks over time. And mortgages, 30-year mortgage, that's actually pushed a lot in the United States because the banks want to make money. They like making interest. If you actually look at a place like Canada, they've banned mortgages that long because they require you to pay so much interest to the bank that it's kind of ridiculous. And I would actually highly recommend when you are playing around with the mortgage calculator that you actually see what it would look like. You know, you have your 25-year mortgage and then look at what you would get for a 30-year mortgage. Look at how much more of a house you could afford, and then also look at how much more interest you're going to pay. And I think you'll be surprised by how much interest that will actually turn out to be, and how little it affects on the amount of more price that you can afford with a home. So 25 years is okay. It's a little bit higher, but you know, if you want to afford a bigger house, that's an okay place. 20 years is sort of your happy medium. That's where, you know, you're trying to balance paying as little interest as possible with still having a nice home. 15 years is if you're really eager and you really want to pay your mortgage off as fast as possible. You know, you want to pay as little interest and you just want to get it done with. 15 years is a good place to be for that. So you have that, you decide on those, and again, you can play with all the different ones and see what you might be able to afford with different timelines. That's a great thing about a mortgage calculator. You can use it as many times as you want in as many scenarios as you want as well. The next thing that you're going to want to look at is how often you plan to actually pay your mortgage. So that's the frequency. So typically, most people will line up their mortgage with their actual, when they receive their pay, so weekly, bi-weekly, monthly. But the more often you pay, so if you pay bi-weekly, you'll actually save on interest because of compounding. So ideally, typically it's just going to be matching up with whenever you pay, whenever you receive your pay from your work, but bi-weekly and weekly are typically better than monthly if you're looking at paying less interest overall. The next thing you're going to want to look at is your down payment. As I've mentioned before in previous videos, you always want to target that 20% amount or more. Realistically, if you're going with less than 20%, it's not a good idea. You're accepting a lot of risk, and you're also going to pay more interest at the bank, and there's also a very good chance you're going to have to pay insurance fees as well. So always want to go for that 20% or more mark. And the final piece of information that you're going to need is your payment amount. Now you might be thinking, that's a bit strange. Don't you typically start with the mortgage amount and then figure out your payment? And that actually is how most mortgage calculators work. When you go to, say, a bank, they'll say, put in a $400,000 mortgage and this is how much you would have to pay. But I personally view that as a very dysfunctional way to go about it. It often encourages people to get way in over their head when they're looking for houses. They often try and buy their dream home and then try and figure out how they can get enough of a payment to make that work. And that's a very dangerous way to go about it. It is much safer to go from the payment way and see what you can actually afford with your payment. Now, how do you figure out how much payment you can do? It's actually pretty simple. You do a budget. And basically you go through, you budget out how much you're going to need for food, clothes, entertainment, and all of those things. And then anything left over, plus any, say, rent you pay right now, would be what you could afford with a mortgage payment. And so then you can plug that in and you'll see what effectively your mortgage amount would be. And now before you go out and buy a house, before you go and start searching for a house, it is incredibly important that you test your budget out first. This is a huge mistake that people make, and it's a very common mistake with budgets, is that people often underestimate how much they actually spend in an area. You might think you can live off $100 of food per month, but when you actually go through and live that month, you might see that you're actually spending $200. It's really important that you test out these categories that you make to make sure that you're actually sort of setting aside enough and allocating enough for those areas. And when it comes to budgets, there is also budgeting software on financesdoneright.com. If you want a more sophisticated budget, Mint has a great one as well. So after you've done that, after you've tested it, it's actually really important, even if you are able to actually sort of afford to live at that budget and you have your payment, it also is important that it's a lifestyle that you're comfortable with. That's another huge mistake that people make. They try and get the biggest house possible and they sacrifice the things they enjoy in life. They cut out the entertainment, the vacations, the eating out, and all of these various things so they can afford the largest and biggest dream house that they can get. That's not a good idea. Because if you have a mortgage that's 25 years long and you're sacrificing all of the things you enjoy in life just for a big home, it's going to be pretty miserable. And so you want to make sure not only that you can afford according to your budget, but you also want to make sure it's a lifestyle and sort of something that you can enjoy. That's really, really important. Make sure that you aren't sacrificing your life for your house. That's a terrible idea. And so you'll see that there's one last spot or one area in the mortgage calculator on financesdoneright.com, and that is the principal payment area. What is that? Well, every time you make a mortgage payment, and let's say that you had a $2,600 mortgage payment, part of that goes to equity, part of that goes to actually buying your house, and part of that goes to paying the interest to the bank. And so what happens is an additional principal payment effectively allows you to pay off your house faster. It allows you to buy your house faster, and you're actually going to pay a lot less interest in the long term. So basically, it's a way for you to accelerate paying off your mortgage and paying less interest. And you can experiment with mortgage payments and see what kind of effect they can have. And again, that's a great thing about a mortgage calculator. You can put in a lot of different scenarios and see what kind of effects they might have. And if you are someone who wants to pay off your mortgage faster, I would highly recommend you figure out your payment amount through your budget, and then you take $100 off, and then you add that $100 to the principal payment. So in the previous example, you would have, instead of a $2,600 mortgage payment, you'd have $2,500, and then add that $100 to the mortgage principal payment, and you will see a phenomenal effect for paying it off faster and paying less interest. Once you have all that information, you'll be able to figure out what kind of houses you can afford, play around with that, see what happens with that. And as always, if you like the video, we very much appreciate a like, share, and subscribe. It helps the channel grow. And have a great day.